I wouldn't call myself a beginner, but I still have a long way to go before I can call myself a professional. I've been trading in the financial markets for several years now, and during that time, I've developed my own approach that combines moderate risk, discipline, and constant analysis of my mistakes. The main instruments I trade are currency pairs, commodities, and stocks of large companies. Trading in the foreign exchange market was my starting point. It was there that I learned to understand how global economic processes work. Currency rates aren't just numbers on a chart. They reflect central bank policies, inflation levels, interest rates, and overall investor sentiment. I most often trade major pairs, such as EUR/USD and USD/JPY, as they have high liquidity and a relatively predictable reaction to news. Over time, I've added commodities to my portfolio: oil, gold, and sometimes natural gas. These instruments behave differently. They're more sensitive to geopolitics and global crises. For example, gold often acts as a safe haven asset, and I use it to hedge risks during periods of instability. Oil, on the other hand, requires a more careful approach. Here, it's important to consider both supply and demand, as well as the decisions of major players. Company stocks became the next step in my trading journey. Unlike currencies, this involves more fundamental analysis. I pay attention to financial statements, company news, and overall industry trends. I usually choose large, well-established companies because they offer more stable price movements and are less prone to sharp fluctuations. My strategy is a combination of technical and fundamental analysis. I use support and resistance levels, monitor trends, and always take the news backdrop into account. At the same time, I try not to overload the chart with indicators. Experience has shown that simple solutions often work better. One of the most important lessons I've learned is risk management. In the past, I made mistakes by opening positions that were too large or ignoring stop-loss orders. Now, I strictly limit my risk per trade and plan possible scenarios in advance. This helps preserve capital even during losing streaks. Psychology plays a huge role in trading. Emotions are a trader's worst enemy. Fear and greed can ruin even the most well-thought-out strategy. I try to stick to a preset plan and avoid making decisions on impulse. Sometimes it's better not to open a trade at all than to enter the market without a clear understanding. I also keep a trading journal. This helps me analyze my actions and identify my weaknesses. Over time, you start to see recurring mistakes and work on correcting them. For me, trading isn't a quick way to make money, but a systematic process that requires patience and continuous improvement. The market is constantly changing, and to stay in the game, you have to adapt. I continue to learn, test new approaches, and refine my strategy. Ultimately, my goal is consistent results over the long term. Not maximum profit here and now, but steady capital growth with controlled risks. It is precisely this approach, in my opinion, that distinguishes an intermediate-level trader from a beginner.